debt and funding, what's the plan here? Oil price prediction, if you can, or where you think it might be heading, and then finally, as a target for starter for 10, sort of a target you'd be aiming for in the next 6 months to get to.
We've got 10 wells that we know are idle and sitting there and have the potential to return to production. So of those, we've drafted programs that have identified 9 that we think we can return profitably to production. Those 9 wells, again, assuming that everything works as planned, can generate essentially 83 to 87 barrels a day of new production, right? So that's on top of a field that's making, at the moment, about 75 barrels. So again, that's the original target. That's the first target, is to get those wells back on production and generating revenue. So that'll take our current production to almost double, and it'll take our current cash flow and more than double it. And so with that, we have $4 million of debt that we inherited. That is stable. We got a great bank that's supporting us. Once we get that up and running, then we're going to start to pay that down. So ideally, we want to get that down to something more in line with, like, say, $1.5 to $2 million. So we see paying a big chunk of that off. Okay. And again, that we'd like to do that in the next year to 18 months. We really want to whittle that down. As far as oil prices go, we have been running our scenarios at $75 a barrel, right? That's our baseline. We do a sensitivity down to 50, and we do a high case scenario at 85, right? Flat. We just run them all flat to see what we do. So we're focused on $75, and everything that our decisions at the moment are based on that. If you look at the forward curve, it's above that at the moment. Our current prices in the field are running about $82, so we're a little kind of ahead of our price forecast, but that's what we expect. Between 75 and 80 is probably where we are forecasting our kind of price to remain. If it's above that, great. If it's below that, we think we can survive. Our operating costs are low. We're running about 11 to $12 a barrel. Right. In some areas of the field, in the Falk wells in particular, the operating costs are like $3 to $4 a barrel. So we're in a very low cost environment, and our oil gets about a WTI price less, $2 to $3. So we're in the right part of the cost curve, and so we think at those prices we have a very profitable business out into the future. Starting that journey, so we can see quarter on quarter improvement in production. That's really what we want to start showing to people. So that'll be your first indication that the turnaround has begun, is once we start to see this increase in production. So that's what I think people should be looking out for.